Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about NEWMARK Group Inc. Annual Report. NEWMARK Group Inc. offers a wide range of commercial real estate services to various clients across the globe. The company's services include capital markets, such as investment sales and mortgage brokerage, as well as landlord representation leasing and valuation advisory. Additionally, NEWMARK provides property management, technology platform capabilities, business rate services in the UK, due diligence consulting, and GSEs/FHA lending services. The company also offers asset management services, flexible workspace solutions for owners, tenant representation leasing, and global corporate services like workplace strategy, energy services, project management, real estate administration, and facilities management. NEWMARK's clients include commercial tenants, investors, owners, developers, lenders, small businesses, and multinational corporations. With a rich history dating back to 1929, the company has evolved into a leading provider of commercial real estate solutions under its current name, NEWMARK Group Inc., since October 2017. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to increase. The NEWMARK Group Inc. is a leading commercial real estate services company that has experienced growth in its stock price over the past year. Several factors may have contributed to this increase. One possible reason is the company's strong financial performance, including revenue growth and increased profitability. This could be due to various factors such as an improving economy, increased demand for commercial real estate services, or effective cost-cutting measures. Another potential factor is the company's strategic acquisitions and partnerships, which may have expanded its market share and capabilities. NEWMARK Group has a history of making strategic investments in other companies, which can help drive growth and increase shareholder value. Additionally, the company's commitment to innovation and technology may be attracting investors who are looking for companies with strong long-term prospects. Furthermore, changes in the regulatory environment or industry trends may also have contributed to the stock price increase. For example, a shift towards more sustainable and environmentally friendly business practices could benefit NEWMARK Group's focus on commercial real estate services. Similarly, an increase in demand for office space due to remote work arrangements could drive growth for the company. Overall, the combination of strong financial performance, strategic acquisitions, commitment to innovation, and favorable industry trends may have contributed to the increase in NEWMARK Group's stock price over the past year. NEWMARK Group Inc. market capitalization of $4 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that NEWMARK Group Inc. holds a significant advantage in their industry. NEWMARK Group Inc. trades at a higher price-to-earnings ratio of 22 times and a higher price-to-book ratio of 1.88 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 68% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth are multifaceted. Notably, the mortgage brokerage and debt placement segment has seen a significant increase of 54% in revenue from 2024 to 2025. This is followed by investment sales, which have grown by 34%. Leasing and other commissions have also contributed to revenue growth, increasing by 17%. Additionally, management services have experienced a 14% boost in revenue. On the other hand, certain activities have led to revenue decline. Rate lock commitments have resulted in a net loss of $1,350, while forward sales contracts have realized a loss of $7,491 and totaled $8,500. $501. Contingent consideration has also contributed to a decline in revenue, with an unrealized loss of $3,236. It is essential to consider the various factors influencing revenue growth or decline. While some segments have experienced significant increases, others have led to losses. A comprehensive understanding of these dynamics can provide valuable insights into the company's financial performance and inform strategic decisions. The net income of the company underwent significant changes between 2023 and 2025. Initially, it increased by 75% due to various factors, such as cost savings from outsourcing commercial real estate services and additional demand for property. However, this growth was short-lived as net income decreased due to increased upfront costs associated with pursuing transactions and recruiting personnel. Furthermore, the impairment of mortgage servicing rights, MSRS, and valuation allowances led to a decrease in net income. Despite these setbacks, the company's net income experienced a significant surge in 2025, increasing by $144.9 million, or 16.9%, to reach $1,002.6 million for leasing and other commissions. Additionally, the overall net income increased from $185,398 to $282,045, representing a 52% increase. The profit margins of the company also underwent changes during this period. Initially, they improved due to cost savings from outsourcing commercial real estate services. However, this improvement was short-lived as profit margins decreased due to increased expenses from integrating accounting and financial systems and accounting policies. Despite these challenges, the company's profit margins showed a significant increase in 2025, rising from 5.1% in 2023 to 6% in 2025. The net income and profit margins of the company demonstrated a mixed trend between 2023 and 2025. While there were periods of decline due to various factors such as increased upfront costs and impairment of MSRS, the overall trend showed an increase in both net income and profit margins. The company's ability to adapt to changing market conditions and implement cost-saving measures contributed to its improved financial performance. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, total debt volumes increased by 67% year-over-year, indicating a substantial rise in debt levels. However, this trend was somewhat offset by the relatively stable corporate debt of $671.7 million as of December 31, 2025. Notably, warehouse facilities debt saw an increase of $100 million from 2024 to 2025, while borrowings outstanding under the credit facility rose from $0 to $75 million. Conversely, total debt decreased by 2.1% from $147.9 million to $151.3 million, and warehouse facility debt increased by only 15%. The company's borrowing activity is also evident in the additional $130 million borrowed under the credit facility on November 8, 2023. Regarding interest expenses, there was a notable increase of 2.2% from 2024 to 2025. However, this trend was not consistent across all types of debt. For instance, warehouse facilities saw a decrease in interest expenses by 12.5%, while the interest expense for 7.5% senior notes increased by $1.375 million. Overall, the company's interest expenses have shown mixed trends, with some areas experiencing significant decreases and others increases. NEWMARK's management is emphasizing the importance of risk management in their company outlook. They are actively mitigating risks through the use of derivatives and other financial instruments, which demonstrates their commitment to minimizing potential losses. In terms of strategy, NEWMARK is focused on growth through strategic acquisitions and partnerships. The recent purchase of Spring11 and partnership with CFE are examples of this approach, aimed at enhancing their capital markets platform. This expansion is expected to drive revenue growth and increase market share. Financial performance is also a key area of focus for the company. Management recognizes that revenues are sensitive to transaction volume in global financial and real estate markets, and interest rate fluctuations can impact financing. As such, they are taking steps to manage these risks and optimize their financial position. In addition to risk management and growth through acquisitions, NEWMARK is also investing in various assets to generate returns. This includes investments in real estate and financial instruments, which allows the company to diversify its portfolio and reduce reliance on any one particular market or asset class. Overall, Newmark's outlook and strategy appear to be centered around managing risks, driving growth through strategic acquisitions and partnerships, and optimizing financial performance. By taking a proactive approach to risk management and investing in diverse assets, the company is well-positioned for long-term success. Newmark's acquisitions and divestitures overview. In recent years, Newmark has made several strategic acquisitions to expand its business and capabilities. One notable acquisition was Berkeley Point Financial LLC in September 2017, which likely enhanced the company's financial services offerings. Additionally, in March 2021, Newmark acquired Nodal, a move that further solidified its position in the industry. On the divestiture side, while there are no explicit mentions of major disposals, several indirect indicators suggest that the company has been streamlining its operations. For instance, repurchasing 10.9 million shares of its own Class A common stock implies a reduction in equity and potentially a shift in focus towards core business areas. Furthermore, the company has acknowledged dispositions resulting from reduced financing availability due to credit rating downgrades or defaults, as well as disposing of portions of its business to optimize operations. The company's financial activities have been marked by a commitment to returning value to its shareholders. One key aspect of this is the payment of dividends. Over the past 3 years, the company has paid out $168.8 million in dividends, demonstrating a consistent effort to reward investors for their loyalty. In addition to dividend payments, the company has also engaged in share buyback transactions. This strategy allows the company to reduce its outstanding share count and potentially boost earnings per share. The company's decision to pursue share buybacks reflects its confidence in its financial position and its desire to create value for shareholders through more direct means. Concerns about inventory buildup or supply chain disruption exist within certain contexts. On page 66, there are worries about supply chain disruptions. Additionally, potential inventory buildup is mentioned as a risk factor related to the changes in administration of government-sponsored enterprises, GSEs, specifically on page 72. These concerns highlight specific areas where issues may arise. That concludes the financial summary for NEWMARK Group Inc. Feel free to comment below, and I will be happy to answer them when possible.